Good morning, everyone. Thank you for joining us for today's session. I'm really excited about our conversation today. Today, we have Jeff Noble with us, the Director of Wealth Advisory Services at BDO. Jeff brings a massive experience on advising high net worth individuals and family offices on complexity of their investment strategy. And today's conversation is going to be guide around family office allocation, alternative credit, and investment principles in general. Again, thank you for having you today, Jeff.
It's a privilege to be here, Mac. Thank you.
Again, before we start, I wanted to just take a moment for you to kind of give us an idea about your role at BDO. I really think it's a unique role, but really important one that you're playing with these family offices and high net worth individual. Can you please kind of give us a little bit of background and how you guide these families to improve their investment strategy aspect?
Sure will. So we start when working with these ultra high net wealth families and individuals with a very comprehensive plan. So we call this an asset, wealth, succession, and legacy plan. I know that's a lot of words, but this is far more than a simple cash flow plan to see someone through to retirement. This is really talking about the intergenerational power that wealth can have. And in conversations with families, we try to understand what their goals and objectives are as a family and individually. So in addition to having conversations with families about their financial capital, which I know is a lot of our conversation for the next little while, we also want to get a good handle on what their human capital is and social capital is and what their values are. And that's how we can really lean into our planning, which is going to be quantitative in nature, and that's what we'll talk about, and also qualitative in nature. The qualitative being around goals, objectives, purpose, and so on. On the quantitative side, when we get a good understanding of the whole of a family's wealth, so we're not simply talking about the investment portfolio, we really want to know what all their financial capital is, all their investments, all their holdings, any collections they may have, and so on. And our planning will help us understand how that can evolve with the current generation and how it may evolve going into the next generations, and I'll say generations plural. We have families that are asking us to plan out a number of generations. Of course, the further out you go, it gets less concise, but certainly gives us an idea as to how things are going to evolve. And it's from the planning that we really get into good conversations and discussions with families about asset allocation.
It's great, actually. The reason I'm saying that this question comes from the fact that our whole existence here at AppGear was to kind of give the family the first vehicle to be able to deploy capital in a passive way while focusing on the wealth preservation aspect and at the same time passive income aspect. Typically family, obviously you know this, but family offices invest completely different with different strategy, different vision. I really think that your experience kind of like guiding them into that complexity, I find that very unique, and I think that many other families are actually quite glad that you're at the room in those conversations.
Well, thanks for that. And we think we have a unique offering as well. Many of the clients that we have the privilege to work with have not new wealth, they have new liquidity. So they've had some wealth in the family that maybe was built up over generations, in real estate or an operating company. We also have families outside the city that have owned acres and acres of farmland, and they have been selling the farmland as well, as interest in farming kind of diminishes as we get through a few generations. And they then find themselves, I had one family say, we feel like we have been dropped into a foreign country and we don't know our way around, we don't have a compass, and we don't speak the language. And we're now into this world called investing, and how do we responsibly deploy our capital and ensure that we don't erode our capital through generations and that there's enough to go around to support everyone.
Well, talking about capital, can you tell us a little bit of your key principles when you are being able to have those conversations with these families? Walk me through that process a little bit in terms of like, how do you see these key principles to guide wealth preservation and the asset allocation?
So we start off helping the family understand what their liquidity needs are. And very often there's not a lot of, I'd say, understanding of what that is. So what do we need to just live our life out? That's part of it. We also want to understand what their liquidity needs may be for any significant purchases they want to make. And we then talk with them about risk. And families will have an appetite for risk for certain things, and an aversion to risk for other things. So you may talk to a family about venture capital, for example, and say, it feels kind of risky to me. We may talk to them about private equity, which is kind of the same, but maybe a bit less risk. And they say, yeah, that I understand, and we're okay to have risk there. So risk appetite, risk aversion. We also want to get some sense from the family as to what their expectations could be for returns. And we find if we're dealing with business owners, they're accustomed to the type of returns that they feel they've been getting from their capital in an operating company. And some are expecting the same thing out of an investment portfolio. When we run into that, we dive a little deeper to really help the client understand that the returns on the investment they have in their business may not have been quite what they thought. They measure things, I will say, differently. They typically look at maybe their profit and loss statement gets a lot more attention than the balance sheet does. So we go through that conversation. So we've talked about liquidity, risk appetite, risk aversion, expectations around returns, and then based on our planning, we give them some sense as to what their return needs will be as opposed to what their expectations are. A typical scenario, Mac, is going to look like this. We have this liquidity, and we would like this liquidity to be double the amount it is for our estate, for our legacy. Yeah. And in the meantime, in the intervening years, which is probably going to be decades, could be a couple of decades, could be 3 decades, depending on the age of that we'll see the older generation. We want to be able to live our lifestyle the way we've been living it. We don't want to contract our lifestyle in a way. We want to do what we want to do and have this capital double over time for us. At the very least, there are concerns around fees and inflation and taxes. And those things need to be considered when we start to do asset allocation.
Well, talking about taxes and fees, but we've been seeing current market environment right now that's quite uncertain. We had new government down south. We have tariff. These families are navigating these things. I would say, in general, what's keeping you up at night for those situations, and how are you navigating those? Because I could tell you here at AppGear, we're actually adjusting as we go dynamically as a family, but more importantly, we actually relying more into a trust now to give a passive income and pre-creating that cash flow and liquidity that you're talking about in a safe way.
So that's a great question, because something alternative asset classes, so things like private credit, private equity, real estate, infrastructure, agriculture, timber, asset classes such as that tend to have less direct relationships with the economy at large. So when you have tariffs, interest rates up and down, the stock market's up and down, we find those asset classes have considerably less volatility to them. Now, up until the last, let's say half year, and talking to clients about these alternative asset classes in the context of less volatility, arguably less risk, and that we'll probably get into that risk piece a bit later, but certainly less volatility and an opportunity to generate tax-efficient capital wealth. Clients have been, I would say, not as open to those opportunities in spite of our best efforts to talk about things like volatility and risk. The last several weeks, that has changed a lot of people's minds, and they finally realize there's so much happening in the world, and there always is, by the way, but right now it's front and center. There's so much going on that we have zero control over. So we have a government now in the U.S. that feels erratic to us. We're not there, so I think we have a different sense of it. And I could say that when I've talked to some that are based in the U.S. I use words like it doesn't feel good to us. Americans think differently than that, and they're getting some sense now of as they're seeing these tariffs unfold and the impact they're having on Canada. When I talk to them, but they're also starting to feel the impact these tariffs are having in the U.S. So these are things that are outside of everyone's control. So as we get into discussions about asset allocation, especially on the alternative asset classes, I'm finding folks are a lot more open to that than what they have been. And we can now show them that these are far less volatile.
It's actually the core of our philosophy at AppGear. It's about that. It's about the fact that we're able to provide some sort of stability, forecast, predictability, and the passive income aspect. And I think that for us, we're seeing a trend from our partners also, who are calling us, who are trying to figure a way how we could have that type of stability when the market right now is quite volatile. But I think the trend been going the last couple of years, the alternative asset class, there's a trend going on here. Can you tell me what's the shift? Is it more a better risk play, or is it more, like you said, the market environment is driving these deaths of families?
So a few things. There has been an attraction to these asset classes for, I think it's probably a couple of decades. And where that attraction has been is in the pension, endowment, and foundation space. Those people managing pensions, endowments, and foundations have been attracted to these assets because of they tend to manage them around a lower risk budget and a higher return budget. Yep. The challenge with these asset classes until the last little while has been they're very difficult to access, very high barrier to entry. So one needed to be able to write a pretty significant check to buy into these strategies. So I'd say 6 or 8 years ago, that started to change, and they became, I'll use a double negative if I can, less inaccessible. So still probably to ultra-high net wealth families, family offices, and so on, but they became available to investors that weren't necessarily investing on behalf of a pension or a foundation. In the last 2.5 to 3 years, they've become very accessible to pretty much any investor. And that's done a few things. One of which is it has increased the awareness of alternative asset classes and open up the eyes and open up the minds of many an investor to say there's more to life than publicly traded stocks and bonds. So I think that's good news. That's also enabled advisors such as ourselves to hone in on the better quality providers of these asset classes, because with this additional access comes challenges around returns, amounts of risk attached to them, and there are some strategies that we're probably not loving that much. So it does allow us to really seek out the best quality in the alternative asset classes. So if we come back to the family that says we want our capital to double for our estate, and we want to also enjoy our lifestyle, they need some asset classes that are going to appreciate over time. Like they want them all to appreciate. And they also need some asset classes that are going to distribute cash. And a strategy like AppGear, where you have very consistent, predictable returns. So if we're looking to have a consistent amount of money coming back to the family, this is an amazing way to do it because of its predictability and stability, and it's very secure. There's not a ton of risk on it, and it spins out some good cash.
Furthermore, I would say also, if you see the decline of the 60-40 portfolio, we had a great post last month about it, and you could see that the more that people are understanding that portfolio is not being able to adapt this current market or with this current economic environment, that is forcing advisors such as yours, also other portfolio managers, to figure ways to kind of compensate from the decline of that easy 60-40 portfolio. I think that also is triggering a lot of the conversation into alternative. But long-term, I think alternative, like you were talking about risk, the illiquidity premium, I call it, I think that's something that most people don't understand. Can you talk about that? And I think that's something that we're trying to actually advocate, where the longer you hold, actually, the longer you could see that illiquidity premium.
Okay, so now we're getting into a good discussion about portfolio construction. So that traditional 60-40, 55-45, but generally a 60-40, 60 being publicly traded equities and 40 being liquid income producing assets. The traditional thinking was that when one of those asset classes was down, the other one would be up. And what we've discovered is that simply isn't the case. And that really reared its head in the year 2022. So just like 2-3 years ago. And I'm saying that because there are more people investing and more people watching this than ever before. More people have portfolios. And it was, what do I do now? And that brought more conversations to looking towards, not all the way, but looking towards that foundation, pension, endowment style portfolio that probably has, I'd say in the case of in the private client world, between 15 and 35% non-traditional asset classes. So the new 60-40, we're hearing things like 40-40-20, but the 40-30-30 seems quite attractive to folks, where there's opportunity to participate in the public markets with that 40%, and the balance being participating in the private markets, in the alternative asset classes. So you mentioned illiquidity premium. And some of the strategies in the alternative space, so private equity, private credit, real estate, infrastructure, and so on, have what are called a close-ended fund. So you make an investment and your capital is not accessible for a period of time, 5, 7, maybe up to 10 years. And what you're giving up for that is hope for at the end of that period of time, the multiple on your capital is pretty significant. So although I can't get at my capital, it's multiplying for me. As the popularity and demand for alternative asset classes increases, we're now seeing a new class called liquid alts, liquid alternative asset classes. So they're not quite as liquid as publicly traded equities. In other words, you can't call your guy right now and get your money tomorrow. Usually there's some, maybe it could be 30 days, could be 60, could be 90, depending on the asset class. Many clients will like that because if they want the capital, they can. If they change their mind, if their risk appetite changes, their risk budget changes, it also allows those of us that construct portfolios to do some balancing and rebalancing within the portfolio if there's liquidity. The other thing that's doing is these liquid vehicles. Many of our clients are saying it's nice to know they're liquid. It's nice to know if we want to withdraw cash, we can. But we think we'd rather leave the money in, and rather than remove the cash distributions, have them stay in and reinvest the money. And now we have the power of something called compounding.
Yeah, so we call it drip at AppGear.
So leave the drip in.
Yeah.
And it keeps filling the bucket.
Exactly.
Right? If you leave the
which I think it's, again, Warren Buffett kind of is the perfect advocate for that, or the compounding, the power of compounding. And everybody finally understand that. And I think when you get that attitude where instead of taking the capital and reinvest it, you could see that power. That's a powerful tool.
And especially when you have, yes, you have the need for liquidity and cash. You also have this requirement, or we want it to be more than hope. We actually want it to be a requirement, and there's a quantitative plan to work with that family and say, yes, we can help you double that capital base for your estate. Mm-hmm. And that's where the power of compounding, and on a behavioral side, and you mentioned Mr. Buffett talks about this a lot, he talks about investor behavior, is managing, frankly, for us, helping manage our clients' behavior, our clients' expectations. And the word that is used by Mr. Buffett and his folks the most, I think, is a word called patience.
Yeah.
Patient capital, you have a strategy, you have a plan, you understand the power of compounding, and it is very powerful.
Again, I think we are very fortunate here at AppGear because since we're family-backed as a fund, one of the key things that we put forward in any single investment is how long can we hold it, and are we comfortable to hold it for that long period of time? Because I think we think here the risk and the alternative is a lot of it had to do with concentration and also the passive income aspect. But if you are comfortable, if you have time and you're a patient investor and you did the right concentration allocation, those are the things that at the end of the day, you can have an outcome that's going to be positive.
Yeah.
And I think that's something we want to take important. You could talk about concentration, for example. When you're allocating, you're sitting there with a family office and allocating to a private fund or a private credit, what's the level of concentration that you feel like that would be a good balance between the distribution aspect and also the liquidity?
So it's going to vary by what a particular family's needs are. Saying that, we look at the purpose for each asset and each asset class that's going into a given portfolio. Some asset classes are intended to enhance returns, enhance value. So that's something where we want the capital to continue to increase. Other asset classes are intended to distribute cash. And AppGear will be an example of that. Again, whether the drip stays in or comes out, it's producing cash. And the third I'm going to call a diversifier. And that's probably the best risk management tool, is diversification of sector, of asset class, geography, and so on. So as we look at each asset, there's this, what we're starting to use a term called competition for capital. And what we mean by that is within a portfolio, there's a competition to put each one of those dollars to work as efficiently as possible. So those dollars are going to generate cash distributions. They're going to generate returns. They may manage risk. There's also somebody tugging away at pennies looking for fees. There's somebody else tugging away at maybe not pennies, but dollars looking for taxes. So looking at this competition for capital, constructing the most resilient portfolio we can, is where we find families get the best results.
So it's a blend between diversification and also concentration into certain asset class.
Yeah. So again, if we get back to this idea, rather than a 60-40, we're looking into this, let's call it a 40-30-30, for example. If 30% are going to be alternatives, what portion of those do we want to be generating cash versus appreciating over time? And some may do a bit of each, especially given the compounding that we talked about. And if we look at, let's say maybe 5 or 6 different alternative asset classes, so we're looking at private credit, which includes mortgages, for example.
Yep.
It includes other things as well. Private equity, there's many different strategies to invest in private equity, real estate, infrastructure, agriculture. Each one of those 5 asset classes has multiple ways by which someone can make those investments. So depending on portfolio size, we would look at how much to concentrate in each of those 5, and then you drill down a bit further and say, okay, we're putting concentration, for example, in private credit. What portion goes into, for example, private mortgages? What goes into a private credit strategy to maybe lending money out to operating companies? Yep. Others are, it's still the construction space, to a construction loan. So private credit takes in many different things. So there's a way to diversify within a concentration, if that makes sense.
Yeah, well, again, that sector it's such a dynamic sector. If you could see the trend going on right now, there's actually talking about private equity. Even private equity is getting closer to a private credit space with their hybrid funds. Blackstone just launched last week another one. We have also KKR, who are becoming big players who are figuring a way how can we bring private equity closer to a private credit strategy because of the cash flow, because of the predictability, because of the aspect. And I think that's the sector that's the new trend. And family offices are taking notice. We're taking notice as well to understand how can we have a hybrid model where we have opportunities where it's look like a private equity deal, but really, can you make it like private credit to give it that stability?
Yeah. So the rotation that we've seen in the last 24 to 30 months on the investor front is investors have shifted away from private equity towards private credit. And, that tells me that investors are saying, I'd rather be a lender than an owner. So what are wrong with these asset classes that folks aren't so crazy about owning them? And if we go back a little bit, we talked about these closed-ended funds where there's no liquidity, no access to liquidity that's invested in those strategies. The investors have been looking for some cash distributions. They've been looking for some exits. It hasn't been happening. And so those that are holding, I think the general partners holding those assets, are trying to meet the demands of investors for cash. And sometimes that involves taking on some debt, some additional leverage. It may also be something called a continuation fund. So what you're seeing, these large managers, you mentioned a couple of them. These are global trillion-dollar managers that are working to create products and strategies that have a feel of private equity and probably a risk and volatility profile of private equity, and will provide additional liquidity to the investors. So that's what we're seeing.
What I like actually a lot about that is retail investors as well. They're gearing a lot of these products to high net worth individuals, but a lot of business owners who have capitals on the sideline who doesn't understand private equity too well. A product like that is geared to a lot of the retail investors to participate in that sector.
So we talked about the barriers to entry into alternative asset classes are much lower than they were. So for retail investors, they are now able to access alternative asset classes. Now they're giving up in exchange to have more liquidity. Retail investors need liquidity for a number of reasons, not the least of which is rebalancing portfolios, and also simply access to cash as their risk profile changes over time. There's typically what's called a liquidity sleeve inside these asset classes. What that means is part of the investment will remain in cash to enable redemptions to happen. That's a drag on returns. Saying all of that, on the retail level, this does give retail investors access to these asset classes, including less volatility, probably greater returns, and now access to the liquidity. So returns may not be what they are for the closed-ended funds that the ultra-high net wealth families are able to get into.
Yeah.
It still does enhance their portfolio for retail investors in a big way.
Yeah, well, I'm a big proponent of democratizing the whole industry. I really think for a long time, like you said, pension funds were able to have access to that sector. Making the sector grow into the retail to the high net worth would be beneficial for everybody.
Right. So the other part here is pensions, endowments, foundations are not concerned about tax.
Yeah.
Retail investors, if they have registered accounts, have less concern about tax. That in the middle of all that are what we'll call ultra high net wealth investors who do have registered accounts, but most of their wealth is not in a registered account. It's often in a family trust or in a holding company, and those are taxable. So in looking at alternative asset classes, we need to pay very close attention into how gains are generated, how income is generated, so that there's what I'm going to call tax arbitrage opportunity to generate the most tax optimized returns that we can.
Yeah, I think it's a balance. I think it's a balance act that everybody is trying to figure a way how we could navigate that. But I really, again, back to the part where I really like the fact that the asset class in general is growing and it's becoming less foreign to a retail investor or a high net worth individual who are just having capital, doesn't know what to do with it. And now we have a clear asset class that could give you that predictability.
Yeah, there are more tools in the toolbox, more strategies to employ for retail investors than there ever have been.
Yeah.
And we're also able to, at the retail level, I'm going to be a little careful because this is probably not where I play very often, so I'll maybe caveat it with that. I would say at the retail level, there are these opportunities have been opened up, and it's allowing retail investors to escape the heavily feed mutual funds, where they're very expensive to hold, and a lot of the returns are eroded by fees. So some of these opportunities they can get into, and part of we talked about the competition for capital. Some of the capital is maybe going to work a little more for the investor and a little bit less for the person charging all the fees inside of a given fund.
Yeah. Well, same here. I mean, I work in the sector like you, to a lot of family offices, but I had a great conversation last week with a partner of ours. And this is a question I wanted to have to you. How do you balance like a first generation and a second generation portfolio construction? The reason I'm saying that, a friend of mine managing an 83-year-old family office, and he's having that kind of like a situation where the second generation is coming along and they're building a different portfolio construction, more focused on returns, which is the older generation is more about wealth preservation. How are you balancing that two dynamic?
So we talked about human capital before and social capital. So we're talking about people, relationships, and values, and purpose, and goals, and objectives. These, to some people, they feel a bit squishy and qualitative in nature. So an important piece in managing anything between two generations is communication. And just as in real estate, you have location. And this work, I use the word governance, and I'll explain that in a moment. We talk about communication. So what I mean by governance is setting up structures, somewhat formal, depending on how a family likes to operate, for communication. What are we going to talk about? Where are we going to talk about it? How do we talk about it? How to respect each other, and decision making. So in the context of a portfolio, where the wealth creator, so that the current generation, is their main concern, and this would be like a kind of a 12 out of 10 concern, is capital preservation. I worked for often decades from a very, very humble beginning, and worked hard and worked smart and had some good luck, had some bad luck. At some point, the good luck started to outweigh the bad luck. And, after this 35, 40, whatever number of years it is, after some number of decades, we find ourselves with this incredible wealth for which we're grateful. And we are really concerned about putting much risk on the table. So I used the term risk budget earlier. They become very risk averse. And I've heard these founders say to their kids, and by the way, I'm saying kids, adult children, we don't have to get rich a second time. Growing up, you didn't see me much because I was out doing this thing. Well, we have this now. Let's not risk our capital.
Yeah.
The next generation, part of it's because they may not have earned the money, although in a lot of cases they were side by side as they became adults with their parents. They look at things a bit differently. Their appetite for risk is often different. And we need to remind them, whose capital are you risking? It may still be the first generation's capital. Maybe it's going to be yours one day, maybe it isn't. So the risk appetite is different. The other thing that the next generation is looking at is something I call the impact of the denominator. So mom and dad are a household. If they have 3 children, there's a sense that if we take the current and divide it by 3, it's going to be a third less for each of it than it currently is.
Yeah.
So back to the conversation earlier, I want my estate to double. In some cases, they're looking at the impact of the denominator, saying, well, first generation down to second generation, there's going to be 3 households.
Yeah.
And if each of those 3 have 3 kids, now we're into those 3 plus another 9. I'm going to lose count here. But you start to get into teens and even more if you can get beyond 3 and 4 generations. So increasing the base capital becomes important. And the balance is between preserving the capital and growing the capital.
Yeah.
So how can we, in this dynamic between generations, help each understand the other's point of view and find some investment strategies to construct a portfolio that doesn't put the initial capital at high risk and still allows for that next generation to experience some growth in the capital for their family?
I think the question come from, this is the core of AppGear. Like when we had the conversation internally to create this vehicle to allocate into asset-backed lending, one of the key thing was, like you said, a lot of the time we look at the initial capital and we call ourselves a steward of family capital. And we behave that way. And we want to make sure that whoever kind of we collaborate with or invest with understand that we're stewarding a capital and we have to make sure we're not after yield, but we're after great investment for the family. And being able to understand that communication is something that we take very seriously, but more importantly, communicate to partners. Because a lot of the time we have conversation with other partners, they have a great opportunity, but it really doesn't fit our risk profile because it's family capital. And they're thinking on the rank where we're not here to, have be rich again, but more, we're not here to chase yield, I call it, but we're here to just have a good investment that we're comfortable, we could sleep well at night.
So this concept of stewardship is something that wealth creators understand, and progressive wealth creators really work hard to put a governance process in place to help the next generations, plural, so their children and their children's children, and their as yet unborn great-grandchildren really understand this concept of stewardship, which is we don't own this capital. It's ours to use and make better for the next generation. I mentioned farmland a bit earlier, and this is something that farmers intuitively understand.
Yeah.
Always improve the land. Always improve your yield. A lot of the same wording actually is used in agriculture. They want a better yield every year, and they understand if they don't look after the land, not only can't they generate an income today, they're going to diminish the value of their asset for future generations. And you can see in Canada, you'll see farms that are into 6 and 7 generations now. Not many, because there's been a lot of consolidation. And this is because they understand this concept of stewardship. So if we can help getting back to social capital and human capital, anything we can do to help families that are deeply concerned about capital preservation understand this concept of stewardship. And families that have been, and there aren't many in Canada because we're still a fairly young country, but you look to Europe and you'll see families that are 8, 9, 10, 12, 13 generations. And they realize that if it's my generation's turn to steward this capital, if I can find ways to generate an average of, wait for it, 7% a year, not 12. And by the way, 5 won't be enough. But we're not looking to hit home runs here. 7% a year, that is excellent stewardship of the capital. And if I can also do that in a way that aligns with the family's values and the values of my siblings and cousins, that is going to generate great capital appreciation and allow everyone to live the way they'd like to live.
You said it, 7% is really the number, but more importantly, I really think that human capital, making sure that everybody understands that number is there for a reason. You're not chasing 14% at some point. And that doesn't, you don't move the goalposts investors do it all the time, but family offices and high net worth individuals have to understand that number is there for a reason, and there's a reason why we put that like a cutoff.
Right. So we talked about at the very beginning the planning process, this asset, wealth, succession, legacy planning we do with families. And a component of that I mentioned is expectations for returns and need for returns. And that need is typically closer to 7. The expectation may be closer to 10.
Yeah.
And there are families that can appreciate part of the portfolio needs to generate more than 7 because sometimes parts of it will generate less than 7. So that's where the diversification piece comes in to help manage that risk. Are there portfolios out there that consistently deliver better than 7? Pretty hard to find. I'm not saying they're not there.
Yeah.
And I think with these alternative asset classes and the capability to have a blending of consistent returns like yours, like the AppGear strategy and others like it, and to have other strategies inside of a portfolio that consistently demonstrate capital appreciation is a pretty good way to put things together.
I would say for somebody who's used to the typical traditional investment, how do you explain to them credit? How do you explain to them in terms of like the easy way to could walk them through that investment class?
So if we're talking about credit with someone, depending on the sophistication of the investor, and someone told me years ago that you need to know enough about anything that you could explain it to your grandmother or to a 7-year-old.
Yeah.
And that means you really have to know what you're doing. If you know a little bit, it's difficult to put it in terms like that. So if we're talking to a business owner, for example, if we're talking to a business owner or former business owner about diversification, their first thinking is, I made all of my money in a single strategy.
Concentration.
Right? It was just this asset, whether it was a single real estate asset or perhaps a farm or an operating company. Most of the clients we're working with had operating companies. So when we want to talk about diversification with them and things like credit, we'll talk about the fact that they had multiple suppliers. Why do they have multiple suppliers? Well, in case one guy wasn't around. Diversification risk. We talk about the fact that in preparing their company for growth and ultimately for exit, they made sure that they had succession planning in place so they weren't dependent or concentrated on a key person. We talked about the fact they had multiple customers in multiple jurisdictions, so they start to get this idea about diversification and managing risk that way. When we talk about credit, the business owner may say, we actually made money on interest. We charge our clients, so we get how that works. Or they're frustrated because they always felt that the banks were making more money than they were. And we're saying, well, this could be your opportunity to be on the side of the table the bank was and actually lending out money through the right strategy so that you can earn a consistent coupon on your investment here. We work to use language that a given client will understand, typically in the context of their life.
Yeah.
Because we find using acronyms and investment terms are great when you and I are talking. Yeah, not so great when we want to talk to the clients that we work with.
Let's go back to due diligence, risk, and how you navigate with that. Here, for example, we use, for example, AppGear, everything is vertically integrated. We use proven technique of underwriting. We use all our asset internally to make sure when we make a decision, we have conviction. Now, when you're guiding these families to provide a fund allocation or selection of managers, where does that conviction come from?
So we do our due diligence not on the investment, for example. We do our due diligence on folks like you.
Okay.
Our due diligence is done on the portfolio managers, investment counselors, fund managers, general partners, and so on. So our diligence is to find out how they look after clients, what a client experience could be like working with that manager. And we're not talking only about relationships and customer service. We're talking about what reports look like. Can they show us what an investor who invested with you X number of years ago, what their experience has been like by way of returns, reporting, what's the consistency of the relationship? So there's a lot of qualitative, I'll call that qualitative due diligence that we do with managers that we feel deserve to work with, families that we're fortunate enough to work with. And part of that diligence, Mac, is going to be understanding the due diligence that you put into your work. Okay. So you're the experts in due diligence, for example, in the world of mortgages, residential mortgages. If that's your specialty, we want to understand the due diligence that you do on behalf of the family you work with. And, speaking of families, we also find in our experience that families really like working with other families. Yep. There's like almost an automatic high level of trust. So you can be 2/3 or 3/4 of the way there before any of this other due diligence happens because it's family to family.
I think for us, it's a secret sauce. I'm not gonna lie. We actually find the fact that we are family back, family vision, family mandate. It's such an easier conversation to talk to co-investment opportunities, and we want to do what we do best, but we use this vehicle as an opportunity to grow the family portfolio, basically, in terms of working with good collaborators, good partner, like-minded family offices, who are doing great thing as well, but we try to participate with them. So having that aspect of family-to-family conversation make it so much easier for us to be able to know what's the value proposition of collaborating.
Yeah. So we often play the role of intermediary in connecting people, connecting families, connecting investors, and one family that's looking to learn about something, we can share an experience, we can share relationships with them, and we're delighted to do that. In the context of capital preservation, and especially if we're going to use words like stewardship and stewarding the capital and being a steward of capital, being a steward really of all the family's capital, so the financial capital as well as the relational capital.
Yeah.
Other families understand that, whereas an investment corporation that's really there for returns is probably not going to understand that because their sole focus is on returns. And when families that want to have a stewardship philosophy start chasing returns, they find that they're mutually exclusive. There's imbalance. You start going up the risk curve, and then we're saying, wait a minute, we're not feeling very much like a steward here. We're taking your family up the risk curve, chasing that opportunity, chasing those returns. So let's come back to what we said we would do, and importantly, why we said we would do what we're doing.
Yeah, well, one of the main thing I think I always like to say internally, if anybody who propose higher return to us, the next question is, what's the risk factor?
What's the risk factor?
There's no but if there's a correlation there. If you're looking for higher return, higher performance, now you got to talk about what's the risk factor that's being taken. And many of the professional asset managers or the corporations, sometimes they kind of put that in the back burner. But families want to know.
Families want to know. So if we come back to the foundational work that we do in planning, and out of that comes the conversation about asset class. In between is a discussion about liquidity, risk appetite, and risk aversion and returns. And there's terminology used like risk-adjusted returns, and there's conversations about volatility, which is not the same as risk. And we really need to help investors, so the ultra-high net wealth families we work with, understand how much volatility can you actually take. Yep. Because I can say this to you, Mac, that investors will underestimate the importance of liquidity and overestimate their tolerance for volatility. And until we get times like we've had very recently, and we had back in 2022, until someone experiences that volatility for themselves, it's only a word, it's only lines, lines going up and down on a paper on a chart. When they experience it, that's when, again, this appreciation for these asset classes really, really starts to come to the fore.
Again, I think our thesis for us was really, if we look at the last 2022, COVID, we kind of saw the market turning, and our CEO kind of was at the bank at the time, and he kind of saw there's going to be a lack of capital to kind of navigate that shift. The first thing we said, we could either create a private equity or create a vehicle that's going to be in the lending space. We underestimate the demand.
The demand in Canada for private credit has accelerated, I'm going to use a heavy word here, dramatically in the last 24 months. Since the pandemic, actually, this probably goes back to the global financial crisis, like 15 years ago or whatever it was, right? 2008, 2009.
Yeah.
And Canadian banks were global poster childs for stability and strength. And as a result of that, the banks have been really bolstering their balance sheets. And the banks in Canada, those 6-7 banks, are hyper-focused on their very, very best clients. And their other clients, which would be the other 98% of their clients, are challenged to get good, reasonably rated loans at term sheets from the institutional banks here. So as a result of that, the demand and need for private credit has grown a lot. And there was a time when there was almost a stigma attached to a business owner that used private credit because the perception was they must be in trouble. The big banks won't lend them money. That's no longer the case. So there's now an access to capital for business owners that require capital for operating capital, for expansion, and so on through private channels. And the same is the case, I think, with what you're offering is to consumers looking for additional money for the residents.
Absolutely. And I would say we've seen the difference also when you see high interest rate environment kind of kicked in, where technically the bank capital, it's pretty much competing with the private market now. At a certain time, people start realizing, okay, well, which process is easiest path to capital if I need the capital yesterday?
So on the private side of things, I think you made a great point that as interest rates have increased, the delta between private capital and bank capital has shrank. The access to capital in the private is better. It's easier. It's easier to access. I think the requirements are less. And importantly for the person that's looking for the credit, the speed at which they get the credit is very important. So in the case of a business owner who perhaps needs to invest in new capital for machinery to fulfill an order, they can't wait 90 days for a bank to figure out if that's a good idea or not. They need it right away, get the machine going, get it set up, and start working with it. And I think in the case of if we're working with residential mortgages, whether it's to put an addition on my home or to buy my first home or to upgrade my home, again, these decisions at the speed of the market, we need an answer very quickly.
Yeah, and most Canadian, most of the wealth, 72% of the wealth is in their residential mortgage, right, in their house. And those are great, and we see that those are great assets that are stable, not like the U.S. where there's a lot of volatility. We're quite stable market, even though right now we're going through a crunch on the condo market. But typically, over the years, Canada have a great real estate market where you're sitting on great asset. If you need, like you said, add a portion of the house, or you have an emergency that you want to kind of like deploy capital into a certain business, you could leverage that. And then they'll be able to get the capital for you to get that done faster than the bank.
Right. And I think the consumer, or the homeowner that's looking for credit, it's a great way. They have this, as you say, this great asset they're sitting on. And often, we need to live someplace. So I think a lot of homeowners don't consider it to be an asset. This thing I own, and that's where I come home from the office every day, that's where I go. And understand they can actually use it for leverage. They can use it to get things they need, things they want. I think private credit is a great way to do that. And the other thing we hear from customers of private credit or users of private credit, in addition to the speed, is the flexibility.
Yeah.
The flexibility of repayment terms. Aren't these huge penalties quite often for prepayments? And I think that is another appealing part about it.
We try to align ourselves with the investment where we understand the pain point. We try to cater to that pain point, and we try to be of added value. AppGear, the whole business values, we want to be a value creation. We want to be also solution as well in the market. So we try to align our product, or we try to align our investment with the end user, knowing that we're solving a real problem.
Right on. And when you come to at least in the family that you're working with and others, when they have this idea around stewardship, capital preservation, I think they know that applies to their clients and customers as well. So on the other side of that loan is a consumer of the credit.
Yeah.
And, it's a family too.
Exactly. And I think that we're taking that approach where it's a human capital you talk about. I think that's our strength as well. We value that. We want to make sure whoever we work with understand that we're not a transactional. We try to stay away from that as far as possible. Understanding that human capital, the end user, we take time to educate, even talking to them, what's the best course of action post-exit.
Yeah. So we find, we talked about families enjoying work with other families and valuing work with other families, and that's about relationship. It's more about relationship and less about the transaction.
Yeah.
And look, we're in the business of doing transactions, and where you separate, in my opinion, a good advisor or a good intermediary, a good manager from an excellent one is the good ones are focused on the transaction, which means they're chasing returns, chasing transactions, and probably chasing fees, versus the great ones who are building relationships, understand with a great relationship, a more solid, less risky, and probably better return transaction could happen later down the road.
That's exactly the core of us. It's really understanding we understand that you could only get return based on risk that can't be diversified, right? So if you cannot diversify the risk, how can you mitigate those risks? Is to know your counterparty.
Right on, know who you're working with.
Exactly. And I think that everybody or every investor should take that approach to know what's your counterparty, because that's really where you get the real value of return. Last question I would say I would have in terms of credit, really, when you're advising these families in terms of asset class, private equity, hedge fund, real estate, over the years, what you're seeing the shift in terms of like which asset class is leading right now?
Right now, like at this moment in time, private credit.
Okay.
Some of the real assets have been struggling the last few years. The rapid run-up in interest rate has hit a lot of real assets. By real, we're talking real estate and some infrastructure investments. There are those who feel that going forward, in the not too distant future, infrastructure may be quite attractive again because of the aging infrastructure we've had, but we've kind of been waiting for that to happen for a while, and we're not quite there.
Yeah.
But the big shift has been away from private equity into private credit, and private credit is now seen as definitely something that can generate consistent distributions. And if there's an opportunity to reinvest, we start to get that compounding impact that you talked about. And there are some structures being set up now that are going to enjoy capital appreciation, which is very tax efficient, and cash distribution. Yeah. So that combination we think is very attractive right now.
Okay. I think we covered a lot of the last 40, 45 minutes. But before we go, can you tell me a little bit, where can if people have questions, family office, high net worth individuals, they would like to have advice or just pick your brain like I do regularly, where they can find you and how they could kind of initiate that conversation or engagement?
Yeah, so you can find me on LinkedIn, Jeff Noble, that's Noble. Probably not best not to have my phone number out here, but delighted to give you my business email, which is jnoble, jnoble at BDO.ca.
Perfect. For me, this is a great conversation with Jeff. I want to say thank you everybody for listening. Please don't forget to follow us at AppGear. We're going to have more conversation like this for the purpose of education in that sector. And please let us know if there's any question that you want to ask Jeff. I will make sure to follow up with him.
Thank you. And thank you all for the privilege of your time. Thank you.